Good morning, good afternoon, and good evening. I'm Sriram Rela, the Executive Director of Basel Practitioners Private Limited. Let me first remind you that the official name of Basel IV is nothing but Basel III Post-Crisis Reforms. For convenience, we are referring them as Basel IV Guidelines. In today's session, we are going to discuss the post-crisis reforms in market risk area. Basel III has mainly focused on the numerator part of the capital adequacy ratio, besides the liquidity issues, whereas Basel IV has focused on the denominator part of the capital adequacy ratio, that is, the risk-weighted assets computation across all the risks. This includes market risk. And the changes in market risk computations are truly significant. If you look at the agenda for this session, there are 5 key important topics. Firstly, I will talk about the evolution of Basel market risk guidelines with a special focus on FRTB. 2 and 3, we will go over the high-level overview of the FRTB standardized approach and FRTB internal models approach. Next, the capital impact of FRTB and the current implementation status. Last but not least, we need to understand the FRTB implementation challenges at the end of the session. As you all agree that this is a big topic to cover in an hour. However, I shall make a sincere attempt to give you the clear understanding of what, why, and how FRTB with a special emphasis on sensitivity-based method. So, most of our time we are going to spend on the second agenda item. Hope that is fine for you all. Let me start off with the first agenda item, evolution of FRTB guidelines. In the evolution, we shall discuss on the history of FRTB, key changes and components of FRTB, and the selection of different approaches or flavors of FRTB. Let me start with what is FRTB. FRTB stands for Fundamental Review of Trading Book. So, basically, it is a review of an existing market risk framework after the global financial crisis. So, why was the review warranted? Well, during the global financial crisis, it is proved beyond doubt that the existing market risk framework failed to assess and compute the adequate capital for market risk. In fact, it was grossly inadequate. So now the question is, what is this existing framework? As you all know, Basel has introduced the framework for minimum capital requirements for market risk in January of 1996. This was part of Basel II Accord itself. And in response to the global financial crisis of 2008, the BCBS has introduced a set of revisions like stressed VaR, incremental risk capital to this market risk framework in July of 2009. These are often referred to as the Basel 2.5 reforms. In fact, Basel 2.5 is just a stopgap arrangement as it did not address any of the structural deficiencies of market risk framework, and it just focused on the immediate need to ensure adequate capital requirements for trading activities. Now, let us closely look at the timelines. BCBS guidelines on market risk are in existence since 1996. During this 2.5 decades, there are 2 major revisions to the market risk guidelines. The first one is the Basel 2.5 in 2009, and the second one is the final guidelines of FRTB in 2019. Effectively, both are aimed to address the shortcomings of Basel II. If you look at the number of consultations, for Basel 2.5, there is only one consultation which mainly focused on the internal model approach. In fact, as I previously mentioned, it is just a stopgap arrangement to increase the capital requirements for advanced banks. However, during FRTB, there are 5 consultations as it is a total revamp of market risk guidelines. So I don't have any hesitation in stating that this is the biggest revision that has happened in Basel IV. Let us now see the key objectives of this revision. the main objective of the FRTB was to develop a new, more robust framework to establish the minimum capital requirements for market risk, drawing on the experience of what went wrong in the build-up to the crisis. If you break it down to finer grain, the first objective is to develop an effective trading book and banking book boundary condition. The second is to achieve a regulatory framework that captures and capitalizes all market risk in the trading book. The third is to achieve the comparable levels of capital across the internal risk models and the standardized approach. Because after all, Basel has offered multiple flavors or approach to suit different banks, but the main objective is to precisely compute the capital required, right? So there should not be any undue advantage for internal model approach banks, and hence improve the sensitivity of standardized approach and also brought the output floor concept. We shall discuss the details in the coming slides. Let us now see what are the key deficiencies in the Basel II 2.5 framework and how FRTB has proposed to address these deficiencies. First issue: classification of instruments or positions into banking book or trading book. As per the existing framework, banks intend to trade is the sole basis for classification of instruments into either banking book or the trading book. And we all know, right, banking book exposures are subjected to credit risk capital requirements, and the trading book exposures are subjected to market risk capital requirements. This inherently subjective criteria gives the possibility for the banks to engage in regulatory capital arbitrage. And this is the biggest design weakness. Now, let us look at the remediation of the FRTB. FRTB has been designed to improve the consistency of implementation of this boundary concept and to reduce the arbitrage opportunities between the capital requirements for market risk and credit risk. The basis for the boundary is still the intent to trade, but the framework has been strengthened by additional specifications and enhancements, including additional specification on the appropriate contents of the trading book, enhanced the supervision oversight, mainly on the rationale of classification, restrictions on the ability to arbitrage the boundary, means not allowing any capital savings on account of moving an instrument from one book to another. Apart from all these things, clearer treatment of risk transfers across the boundary. I mean, banks may choose to hedge some of the risks in the banking book via instruments held in the trading book. So, this framework specifies a consistent treatment of internal risk transfers of equity risk and interest rate risk from the banking book to the trading book. By providing these additional specifications, FRTB is going to address this banking book and trading book boundary issue. Hope this helps you. Now, let us look at issue number 2. In fact, it has 2 parts. First, it is related to approval of models. In the current framework, supervisory approval of internal models is at the bank level. So if suddenly a bank fails to renew its approval, banks as a whole will be forced to adopt standardized approach, and there will be a sudden change or cliff effect in the overall capital requirements. Second part is the internal models approach or value at risk model. We know, right, VAR is not sufficiently comprehensive to incorporate all relevant risk drivers that could actually lead to material losses. VAR basically ignores the tail risk, market illiquidity, and doesn't capture credit risk inherent in the trading positions. On top of it, it accounts hedging and diversification benefits liberally. Now, let us look at its remediation. I shall cover this in a bit detailed manner while explaining the IMA approach, but for now, let me state how FRTB has proposed to address these issues. First, change the model approval from bank level to trade desk level. Second, introduce the accepted shortfall in place of VAR. Third, introduced risk factor level approval to identify the non-modelable risk factors, and also introduced a new revised default risk computation. Now, let us see the issue number 3, the standardized approach. So, the current modified duration or maturity level actually lacks the risk sensitivity and therefore was not a credible alternative and complement to the internal model's approach. Furthermore, its calibration remained unchanged from its introduction in 1996. Due to this, there is a huge unexplained variation in the capital computations between the IMM approach and the standardized approach. Now, let us look at the remediation. The revised standardized approach is designed to be more risk sensitive than Basel 2.5 framework. It has 3 components. First, sensitivities-based method. Second, standardized default risk capital requirements. And third, residual risk add-on. The sum of these 3 components determines the overall capital requirement. We're going to discuss in detail about this component. So, this gives a snapshot of the key components between Basel 2.5 and Basel 4. Let us start with standardized approach. In the current framework, we are required to compute specific risk charge and general market risk charge. For general market risk charge, there are 2 methods like modified duration or maturity method. As discussed just now in the revised STD, we have 3 components: sensitivity-based, default risk, and residual risk add-on. Now, let us look at simplified standardized approach. There is no simplified standardized approach in Basel 2.5. In Basel 4, this has been introduced for small and non-complex banks. The current Basel 2.5 standardized approach will be retained as a simplified alternative with some scalar factors. The scalars per risk class are set at 1.3 for interest rate risk, 1.5 for equity risk, 1.9 for commodity risk, and 1.2 for FX risk. As the scalars are multiplied by the capital requirement calculated under the Basel 2.5 framework, the scalar of 1.3 for the interest rate risk means a 30% increase in capital requirements relative to Basel 2.5. Now, coming to the complex IMM approach, in Basel 2.5, we have VAR, stressed VAR, and IRC. The stressed VAR metric takes better account of tail risk, whereas IRC for both default and migration risk. In Basel 4, we have expected shortfall, non-modelable risk factors, and default risk charge. Let us see which approach is for what bank. By default, the approach that is available for all banks is the standardized approach. For small and non-complex banks, subject to some conditions, banks can follow the simplified standardized approach, which is nothing but a scaled version of Basel 2.5 standardized approach. IMM approach. This is subjected to stringent approval process at different levels such as bank level, trade desk level, and even at the risk factor level. Banks have the option to nominate all or few of their trade desks for approval. Those which are not nominated will be subjected to standardized approach. Trading desks which are nominated are subjected to both the P&L, attribution, and backtesting. If failed beyond the threshold level, they are subjected to standardized approach. If the failure is within the threshold level, they are allowed to follow IMA approach but need to add capital surcharge. Besides the model approval at each trade desk level, the risk factors are also subjected to an eligibility test mainly based on the observable market prices. So finally, those trade desks which passes both the PLA and backtest and those risk factors which pass the eligibility test will be subjected to IME approach. This graded level of approval helps the regulator to monitor the banks closely and effectively. For the banks, it helps to avoid the cliff effect on the capital charge in case of approval failure. Now, let us move on to the second and major agenda item for this session, that is sensitivity-based approach. I assume that all of you are aware of this basic terminology, without which it will be truly confusing. I will try to just skim through this terminology for the benefit of those who are not clear. Risk position, the value of the instrument which is exposed to risk of loss due to variations in the market variables or risk factors. Then what is risk factors? These are the market variables which drives the change in the value of instruments like interest rate, equity prices, exchange rates, etc. What is a risk class? It is a grouping concept like Basel asset classes in credit risk. These classes are proposed mainly based on the risk drivers or risk factors. Risk bucket is visualized as a subgroup within each risk class. Sensitivity is the change in value of the instrument for a unit change in the risk driver. Now coming on to delta risk, vega risk and curvature risk. Delta risk measures the change in price due to a small price or rate shock to the value of each relevant risk factor. Vega risk is a risk due to variations in the volatility for options computed as the product of the vega of a given option and its implied volatility. And curvature risk captures the additional risk due to movement in the delta when the price changes. Both vega and curvature are applicable only for those instruments where optionality is embedded. Let me now show you the exact information proposed by FRTB, which makes you understand better than understanding the abstract definitions. Now, let us look at this table. The leftmost column is having 7 different risk classes like GIRR, equity, forex, commodity, and CSR, which is the credit spread risk. The next column has risk buckets. For example, in the case of GIRR, each currency is treated as one of the risk buckets. If you look at the equity, risk buckets are based on market capitalization, economy, emerging or advanced, and the sector. The next column is risk measures like delta, vega, and curvature, which I've just explained. Now, if we look at the last column, it has the regulatory risk factors. In GIRR, the risk factors have been defined based on 2 factors. A risk-free yielded curve for each currency and tenors. Hope this gives you some idea about risk classes, risk buckets, risk measures, and risk factor. Now, coming to comparison with credit risk, we all are familiar with credit risk, which is straightforward, but if you look at market risk, specifically FRTB, there will be multiple computations, though it is standardized approach. Why is it so? I thought of explaining this by comparing credit risk capital computation. Hope this helps you understand intuitively. In credit risk, we map the exposures to different Basel asset classes based on the party type and product type. So party and product characteristics are the main risk drivers for credit risk. After proper bucketing of the exposures into different risk classes, we shall assign the risk weight based on the external rating. Issues and issuer ratings are considered. Finally, compute the RWA by multiplying with EAD with risk weight. I took the plain vanilla case of no mitigation for simplicity. Please note that in credit risk, an exposure can be mapped to one and only one asset class, and even we shall have one and only one risk weight in the plain vanilla case. Now, let us look at market risk. One instrument or risk position can be mapped to more than one risk class. Let me give you an example. A non-securitized corporate bond denominated in a currency other than the reporting currency of the bank. The value of this instrument will be impacted by different risk factors like interest rate, exchange rate, and credit spread. So it has risk exposure mapped to 3 different asset classes like GIRR, CSR, and exchange rate. This is one of the biggest reasons for computation complexity. Now, let us further understand. Within each risk class, different risk buckets have been created to facilitate computation of similar risk factors and handle diversification benefits consistently. This adds further complexity because the concept of risk bucket is not there in credit risk. The most important thing is capital computation, which is based on the risk sensitivity at each risk factor of the instrument and not the exposure value. And don't forget that one instrument can have multiple risk factors. We just saw in the example, right? On top of all these things, the risk factors have different types of impact on the value of instrument like linear impact, delta and vega, and non-linear impact, curvature. Compute the net sensitivities of each risk factor across the instruments and then apply the regulatory risk weights, followed by sequential aggregations at bucket level, risk class level, duly factoring the correlations for diversification benefits. Hence, we end up in doing multiple computations to precisely estimate the total impact of different risk types on a particular instrument. Don't forget, in market risk, we are first computing the capital charge and then RWA, whereas in credit risk, we are first computing the RWA, then the capital charge in STD approach. Hope this gives you some idea on multiple steps involved in the computation of market risk capital charge. Now, let us discuss on the FRTB standardized approach. Instruments are first mapped to a set of regulatory prescribed risk classes and risk buckets based on the regulatory prescribed risk factors critical to each instrument. The bank would use sensitivities derived from its pricing models to determine the size of its risk positions with respect to each risk factor and compute the delta, vega, and curvature risk charges. For those instruments which have credit risk, a separate default risk charge is computed. If the instrument belongs to an exotic category, an additional risk add-on is required for computation. The sum of all these three capital charges is treated as capital charge under standardized approach. These are the high-level steps we need to perform for each asset class. Now let us drill down to each component of standardized approach, starting with delta and vega. The delta and vega risk charge computation methodology is very similar in nature as they are linear risk charges. Delta is required for all, whereas vega is required only for option embedded instruments. The computational procedure for linear risks can be divided into 5 calculation steps. Step 1. Assignment of positions to risk classes, buckets, and risk factors. In this picture, I've shown 7 risk classes. For risk class 1, there are 3 risk buckets like B, C, and D at instrument level. Step 2. Calculation of the risk factor sensitivities at instrument level. In this example, I've shown that risk bucket B is having 3 risk factors like K, L, and M. So the requirement is to calculate the sensitivity for each risk factor and compute the net sensitivity of a risk factor and across the instruments. Step 3. Calculation of weighted sensitivities at a risk factor level using the regulatory risk weights across the instruments. Step 4. Aggregation of weighted sensitivities per bucket, duly factoring the diversification benefits through correlation. Step 5. Aggregation of capital charge on risk class level, and no diversification benefit is made available, so it is a simple sum. If you look back, we started with instrument level, then risk factor level, then bucket, then risk class, finally at trading desk level. Let me explain this through an example. Hope that makes the concepts clear. The objective of this illustration is making you understand the different steps in the computation and also to make you understand the data and computational intensity of FRTB standardized approach. Please don't try to validate the numbers because this is for GIRR delta computation, so it is one of the 21 different combinations, 7 asset classes and 3 risk sensitivities, so total of 21 different computations. I'm just presenting you one. For this illustration, consider 7 different instruments like amortized bonds, and cross-currency bias swaps. For swaps, we need to pay leg and receiver leg. If you look at the bonds, one is short bond and all others are long. Different rate curves are used in the pricing model of these bonds. For each bond at each regulatory defined vector, we need to get the delta sensitivities. Step 2. Rearranging these sensitivities ratings curve-wise. So we just transpose the instrument-wise information into rating curve-wise. This is just for computational facilitation. Step 3. Net sensitivities across the instruments, effectively at each risk factor level, which is nothing but an interest rate curve and vertices. Step 4. Now we need to get the risk weightings of these net sensitivities, again at the risk factor level. The regulator has prescribed the risk weight for each vertex. So we multiply the net sensitivity with the corresponding risk weight. This is also at the risk factor level. Step 5, 6 and 7 are intermediate steps to compute the risk charge at the risk bucket level. Squaring the weighted sensitivities, this is the intermediate step. This value is required for computing bucket level risk charge. Creating the correlation matrix, this depends on the number of participating curves. Then computing the bucket level risk charge as per the regulatory given formula. Computing the risk charge across the buckets, that is at the risk class level. And cross-bucket correlations are provided by the regulator. So the computation of each sensitivity risk charge is done starting with instrument level information and then sequentially aggregating at risk factor level, then bucket and risk class level. Hope this helps you. If you understand the illustration of one component like GIRR delta, the rest will be more or less similar with some changes. Let us now see the curvature risk. The computational approach for non-linear risks can be divided into 3 calculation steps. The curvature risk measure represents the incremental risk not captured by the delta risk of price changes in the value of an option. Step 0, mapping of the instruments to risk classes or buckets, which we have already done. Step 1, finding a net curvature risk charge, the CVRK, across instruments for a risk factor. This also starts with instrument level and then net at the risk factor level. Step 2, aggregation of curvature risk exposure within each bucket using the corresponding prescribed correlation. Step 3, aggregation of curvature risk positions across buckets within each risk class. You will need to apply the basic concepts of aggregation we have discussed in the earlier illustrations. Now, we have seen the computation of delta, vega, and curvature risk charges at different levels, starting at instrument level and then sequentially aggregating to risk class level, duly factoring the correlation for diversification benefit at each level. Now, one more complexity. We know that correlations increase or decrease in periods of financial stress. Hence, we need to compute risk charges under 3 different correlation scenarios: low correlation, medium, and maximum. This is done by using multipliers for correlation parameters between risk factors within a bucket and correlation across bucket within a risk class. If you look at the picture for trade desk 1, risk class 1, we are required to compute delta, vega, and curvature under 3 different scenarios. At each scenario, we need to aggregate these numbers to get the sensitivity-based capital charge, that is SPC low, SPC medium, and SPC high. And max of these things is considered the SPC for that risk class. Similarly, we need to compute the SPC for all the risk class. You can see on the right hand side SPC 1 to 7. Simple aggregation of SPC 1 to 7 will give the sensitivity-based capital charge for all the risk classes, which is nothing but a trade desk SPC. If we want at bank level, we just need to aggregate the SPC of all trading desks. Just be aware we compute only the SPC. However, we have 2 more components left out in standardized approach. They are default risk charge and residual risk add-on. Trust me, they are not as complex as SPC capital. Now, let us review them also. What is DRC? Default risk is the risk of loss on account of default of issuer or obligor. But did we not capture the default risk within sensitivity-based capital under credit spread risk class? In fact, we captured only the migration and not the jump to the default. Hence, this is required in addition to sensitivity-based capital charge. So what is GTD? Jump to default is the risk of a sudden default. JTD exposure refers to the loss that could be incurred from a JTD event. How do we compute the default risk in credit risk? We all know that in credit risk, we compute the expected loss as a product of PD times LGD times EAD. In this case, our PD is 100%. So it is just a product of LGD and exposure at default, which is nothing but your notional principal plus P&L. So the formula is very straightforward. Do not forget to compute the default risk at the risk class level, starting with instrument level and sequentially aggregating at different level like obligor, then bucket, and then risk class level. At the obligor level, offsetting is permitted. Offsetting refers to the netting of exposures to the same obligor, where a short exposure may be subtracted in full form of a long exposure. At the bucket level, across obligors, partial hedging is permitted, where the risk of long and short exposures in distinct obligors do not fully offset due to the basis or correlation risks. Hence, hedging ratio is computed. With this understanding, now look at the steps. Now, if you can see the steps, the gross JTD risk of each exposure is computed separately. This is at the instrument level. The net JTD risk positions are calculated by using offsetting rules. This is at the obligor level. Within a bucket, hedging benefit and arrive at net JTD per bucket. This is at the bucket level. Risk weight the net positions and then aggregated. Regulators have prescribed different risk weights to different buckets. Bucket level DRCs are aggregated as a simple sum. This is at a risk class level. I don't want to spend much time on this, so let us quickly see what it is and where and how it is applied. The residual add-on is to be calculated for all instruments bearing residual risk separately in addition to other components of the capital requirement under the standardized approach. Residual risk add-on, RRAO, is the risk weights applied to notional amounts of instruments with non-linear payoffs. So which instruments are subjected to RRAO? Instruments with an exotic underlying, like longevity risk, weather, natural disasters, etc. And instruments bearing other residual risks, such as gap risk, behavioral risk, correlation risks, etc. The RRAO is the simple sum of gross notional amounts of the instruments bearing residual risks multiplied by a risk weight, 1% and 0.1%. Having covered the standardized approach, let us review the key changes in IMA approach, which is nothing but the expected shortfall method. 1. Enhanced model approval process. Under the revised framework, model approval is granted at the trading desk level. A trading desk internal model must pass two tests. Profit and loss attribution is a test to determine whether the internal model comprehensively measures the risks that drive the daily profits and losses of the trading desk. Backtesting is a test to determine if the risk estimated by the internal model is sufficiently conservative to cover observed trading losses. Trading desks with internal models that fail these tests must use the standardized approach. Expected shortfall. Expected shortfall is designed to address all the three key issues of VAR, like tail risk, market illiquidity, and liberal diversification benefit issues. Tail risk, value at risk or VAR, calculates the maximum loss expected or worst case scenario on an investment over a given time period and given a specific degree of confidence. So it doesn't count the losses that happen beyond that confidence level. Thus, it ignores the tail event. In the expected shortfall graph, let us assume that the red line is at 97.5%. At this confidence level, VAR measures the maximum loss of 100 million. Other way of saying this is only in 2.5% times the loss exceeded by 100 million. However, ES calculates the average loss above this confidence level. In other words, above 100 million. So for a given confidence level, ES is more than the combined VAR and stressed VAR. Market liquidity risk. The current framework computes a 10-day VAR. It is assuming that a position can be liquidated without affecting market prices in a period of 10 days, which is incorrect in the period of stress. To recognize the risk of market illiquidity, the ES measure prescribes different liquidity horizons for different risk factors. Diversification issue. There is a liberal recognition of the risk-reducing effects of hedging and diversification. VAR has no constraint in recognizing hedging and diversification benefits across different asset classes, example equities and forex, based on estimates of correlations derived from pre-crisis historical data. In the crisis, the diversification effects that were based on historical data disappeared. Under ES, it calculates two versions of ES, one with full diversification, which is unconstrained, and another with zero diversification, which is constrained, and takes the average. This addresses the diversification issue also. Part 3. Limits on the modeling of illiquidity and unobservable risk factors. The Basel 2.5 VAR approach allows banks to model all risks inherent in their trading portfolio. NMRFs are excluded from the ES calculation. Instead, the capital requirement for each NMRF is determined by means of a stress test. Risk factors that do not have sufficient observable market data are deemed to be non-modelable. Revised treatment of default risk. Even in IMA approach, we are required to compute the default risk charge. We are going to use VAR method at 99% confidence level. Unlike in standardized approach, wherein we are using LGD and notional amount, here we shall use the VAR model. Internal model approach is based on expected shortfall method. However, only the default capital charge portion uses VAR. Point 4. Now let us discuss the output floor, which is one of the very significant change which has been brought in Basel IV. The revised output floor limits the amount of capital benefit a bank can obtain from its use of internal models relative to using the standardized approaches. In the example given, if the capital charge under STD approach is 100 million and IMA is 60 million, bank need to consider 72.5 million is the capital instead of 60 million due to the output floor. This limits the benefit of a bank can gain from using internal models to 27.5%. Output floor is designed to reduce the inconsistency in RWAs not justified by the risk fundamentals. This was the most controversial aspect of the package, which some BCBS members initially resisting to accept this proposal. Due to the potential impact of the floor, BCBS has agreed to implement the floor over a phased-in period of 5 years. This is in brief about the IMA approach under FRTB. BCBS runs a quantitative impact study every 6 months to monitor the impact of the Basel III framework on banks and to determine the effect of the proposed revisions to the framework on capital requirements. The most recent report was published in Feb of 2022 based on 2021 data. The results show a 55% increase in market risk capital requirements versus Basel 2.5 with the adoption of FRTB. Implementation of FRTB in the United States presents unique and difficult challenges because US regulators have already adopted a separate capital charge explicitly designed to capture tail risk, the global market shock, a component of the Dodd-Frank Act stress tests. For specific understanding of the capital impact of FRTB, Bank Policy Institution has conducted a study with 6 US banks and presented the findings in the bar chart. The banks considered are Bank of America, Wells Fargo, JP Morgan, Capital One, GS, and MS. In the chart, the purple block of 57 billions is GMS add-on. Now, let us see what is the market risk capital charge. Under Basel 2.5, it is 43 billion. FRTB with IMA would be 66 billion, and FRTB with STD will be 81 billion. If we add the GMS to these three scenarios, it will be 100, 123, and 138 billion respectively. The aggregate capital requirements for market risk for the 6 trading banks would increase from 100 billion to 123 billion with IMA and to 138 billion without IMA. The existing framework already requires overcapitalization for market risk. Overall, what I can say is under the FRTB regime, the capital requirement is going to increase significantly. BCBS publishes the progress report on adoption of the Basel regulatory framework every 6 months. However, it is overdue since more than a year. This was based on the report published in October of 2021. Let me quickly explain the color coding and the number. Number 1 is no draft guidelines. Number 2, draft guidelines are published. Number 3, final guidelines are published. Number 4, final rule is in force. Number 5, green, adoption is completed. Number 6, yellow, in progress. Number 7, red, breach the timelines. Let us focus on FRTB adoption. Highlighted in the red box, except couple of jurisdictions like Canada, Singapore, Japan, no jurisdiction has issued the draft guidelines as they are still in consultation. EU has partially implemented the FRTB guidelines and all other jurisdictions are gearing up to issue guidelines. So we can expect more activity in this space very soon. What does the introduction of FRTB actually mean for financial institutions, and what are the main challenges faced by those seeking to implement it? There are 4 things specifically: structure and cost of business, data, governance and controls, and technology. Let me start with structure and cost of business. Product with non-modelable risk and exotic products attracts more capital, so unless there is a strong business case, banks can't support these products. Real-time desk monitoring. Banks struggle to satisfy the need for a real-time desk monitoring. They need to put in place refined policies and procedures to achieve this. Coming to data, FRTB puts more emphasis on the data sourcing and its quality. So banks need to source sensitivities, market, and reference data. Under IMA, data for risk factors pertaining to complex embedded instrument will be scarce, and getting real quotes will be challenging in rendering the risk factors as non-modelable. Risk and market data must be aligned between front and back office to ensure qualification under profit and loss attribution test. Therefore, huge volumes of data across asset classes have to be migrated from front to back office. For revised SA, front office already has most of the sensitivities and therefore must be sourced into risk system for capital calculation. Complying with BCBS 239 is going to be more challenging under FRTB regime. Coming to governance and controls, deviation from trading and banking book allocation rules needs substantial reasoning and regulatory approval. Policies and procedures governing the movement of positions will play a vital role in adhering to regulatory mandate. Eligibility test for IMA qualification will involve maintenance of models across desks and asset classes, assessments, approval of result, data lineage, and reporting capabilities. Lastly, technology. One way of dealing with these data challenges is to improve the use of technology. Implementing common data hierarchies on big data infrastructure such as Hadoop, HT Insight, or NoSQL can significantly help manage your data. Still, there are considerable challenges associated with migrating data and computations. All these need to be addressed in a structured manner that provides a framework for good, compliant data management in the future. Hope this helps you all, and thank you very much for listening.